Right. Hello and welcome. Thanks for joining us for Max Financial Services Market Updates Thursday, every Thursday calls. Exciting week so far. Maybe may not be a good week, but it was absolutely an exciting week that we've had so far. Our first trading week of the year. Obviously, I'm sure everybody has seen the headlines. Pretty brutal. Start to the year for the market so far. It almost didn't really matter where you're investing in, whether it's domestically or abroad, but it was a pretty bad time. What we have is, since we don't have really week over week numbers yet, we'll talk about year to date. The Dow Jones finished day at 16,514. So far, we're down 5.2% for the year. The S&P 500 is finishing up at 1,943.09, which is a loss of 4.92% for the year. Oil, multi-year, almost multi-decade, close lows. Oil finished up at 33.26. That's for West Texas Intermediate, which is the oil that we have here. Brent is a little bit higher. I don't recall the exact numbers on those. The ones that are positive for the year so far, gold and silver. Gold finished up a bit at $1,108.70 per troy ounce, and silver closed up at $14.31. Biggest explanation for that is simply because everything is really in a state of panic. So gold and silver in most people's portfolios will act as a hedge. Then I'm sure we have commercials that are out there, and those are driving the prices up a little bit. Even though we're commodities, if you really take a look at the picture that's basically being presented, if the economy is weak, that means commodities should be weak, which means natural resources, metals, they should be down as well. In this case, gold and silver are up, so it's the pure trade that you usually have. One indicator that we look at to quantify the volatility we had in the market is the VIX indicator. The VIX closed up at 24.99. To give you a point of reference, last time we had the updates call, which was December 18th, the VIX was at 20.34. Typically 13.14 is where we were for the most part, so we have a heightened sense of volatility. The one thing that a lot of people will be happy about, particularly if you're purchasing a home or if you're looking to refinance or if you have any other type of debt, even though the Federal Reserve raised interest rates at the end of last year, they raised them on the short-term rates. Long-term rates have actually been coming down, which was one of our predictions that we had for 2016. The 10-year bond, U.S. Treasury bond, closed the day at 2.15% for 10 years. And the 30-year Treasury closed down at 2.93%, which was actually inclusive of the Treasury auctions that we've had today, actually. It's a sign. People are basically concerned. People are leaving the equity markets, and they're willing to put them into U.S. Treasury bonds. One of the things people talk about all the time, it's like, oh, well, Treasury rates are so low, they have to go up. Well, no, they don't have to go up. Particularly when you're looking at look at Japan, the 10-year Japanese treasuries were right around 0.5%. You take a look at the German 10-year treasuries, they're at about 0.5%. The Swiss 10-year is actually negative. So basically keep that in mind, keep it as a point of consideration. We can go down quite a bit more. Biggest pieces of economic news this week, we had today the Bloomberg Consumer Confidence Index came out at 44.2, which was up from 43.6. The Consumer Confidence Index is a proprietary index by Bloomberg. Basically, it's been up for 4 weeks in a row. It's at the best point in time since last October. Hopefully, basically indicating that, you know what, consumers are actually feeling fairly confident about their job security and so forth, and the job numbers are actually pretty decent. We had unemployment numbers a couple of days ago, and the new jobless claims were actually lower than were expected by about 10,000 claims. To give more cloudiness To the murky waters we already have. On Tuesday, we had the motor vehicle sales numbers. The prior index was at 14.4 million vehicles sold. The consensus was for 14.2 million, and the actual numbers came out at 13.9 million vehicles sold. What was an interesting point is, particularly if you're in the Northeast, maybe if you're in the middle of the country, it might not, but over 60% have been trucks. It's crazy numbers. One thing to keep in mind, even though vehicle sales are down, they do make up 1/5 of the total retail sales number. So when people look at how our economy is doing as a whole, vehicle sales is a good chunk of it. So basically keep that in mind. For instance, during the recessions, those vehicle sales numbers were significantly lower. And we can basically have debates as to why that's happening. Either the market's oversaturated, or whether there's basically another bubble in vehicle loans, or if the short-term rates, if they started increasing the interest rate that people are paying on loans, and there's no more 0% loans for a car. So we can take a look at that. On a company front, Macy's announced that they're going to be shutting down stores amid weaker holiday sales numbers. They're planning to shut down 40 stores, cut 5,000 jobs, and basically that's going to cut expenses by about $400 million and about 3% of the workforce. Further than that, they are also trimming 3 or 4 positions at the remaining 770 stores, which basically is going to cut another 3,200 or so associates throughout the country. Keep in mind, this is already on top of the store closures that they've announced. When was this? I believe back in September. Once again, more cloudiness to the waters that we have in our state of the economy. On the global macroeconomic front, did not really take a look at the numbers, but the big story internationally was the Chinese stock markets. They're down about 11% year to date in only a couple of trading days. Basically, one of the things to keep in mind is in order to prevent a lot of the market meltdowns, a lot of the stock markets, they have what they call circuit breakers. Basically, it's there kind of to prevent the flash crashes that we've had. In China, those breakers were triggered twice due to 7% or higher drops that we've had. So today was actually last night was one of those days, and that basically transferred over into our markets today. The key takeaways, in the short term, it looks like it's a gross overreaction to what's happening, but anybody who's known me, if you've paid attention to our 2016 predictions, I do feel that we're pretty much close to the end of the bull market, and we're due for a correction. What's scary is when we have 5% sell-off in a week. In all likelihood, we'll probably see a little bit of a bounce back, or when people basically come back in, but it does basically give time to pause and really start evaluating, okay, how much money have I made? Is it basically time to start capitalizing on those? Is it basically time to start making some portfolio moves? Biggest takeaway, active management will be necessary. Much like last year, a lot of the people who are invested in index funds, that's no longer going to be viable. Index funds, basically, when things sell off, everything is going to sell off. While in reality, there is a number of actively managed funds that actually did really, really well. If you take a look at our Seeking Alpha profile on Seeking Alpha, where we do the articles, we highlighted one Aberdeen small cap mutual fund that was up 9% last year in a market which was down about 1 or 2%, and the small cap markets were down about 5%. So lots of takeaways from there, and that's basically that. Hopefully you guys found this of value. Keep this in mind. If you have any questions, feel free to reach out to us. Feel free to send us an email or give us a call. Hopefully you found this of value, and we'll see you next Tuesday for our financial planning call, and otherwise next Thursday for our market updates call. Thank you.